Thank you so much, Colette. So we had over 470 people who signed up, Kristen. When I was marketing chair, I don't think we had an event that had this many signed up. So I don't know, like this is definitely a record breaking like even virtual event. So I don't have the data for the past year and a half, but this is incredible. And to be honest, we have people who from other schools reached out to us to attend the event from Harvard, Yale, Columbia. So we don't have only MIT community, but we have people from a lot of schools joining in today. I am gonna let people to still come in. Colette, when you feel safe, it's good to go. I'm gonna start with the introduction.
I'm delighted so many people were interested in joining. I mean, this topic is near and dear to my heart. And I do think that, and we will get to this, but like it is a moment in time when fundraising is tricky. And so sort of having, perspective, being able to see around corners, if you will, can make all the difference. I think especially, I think oftentimes first-time founders don't necessarily know what they don't know. And so equipping people with some foundational knowledge to navigate the entrepreneurship journey and the fundraising journey can sometimes make a difference. So delighted to be covering this today together.
Yeah, and especially like I read on TechCrunch that there's stricter investor expectations now when it comes to fundraising. Higher failure rates in US startups has caused also more challenges for startups. So um, very relevant session. And also we have to do your other so Kristen, you send me 3 other besides this incredible series for founders, and we love to do all of those with you as well. So I'm going to start. 193 people have signed in, and they are going up, but I'm going to start with the introduction, and I will share the relevant information in the chat during the session as well. So good afternoon, everyone. Thank you for joining us today, and welcome to today's Founders Workshop session with Kristen Kraft. The Founder Workshop is an initiative under MIT Female Founders, which operates under MIT Sloan Club of New York. And the subject of today's session is preparing for Series A, focusing on cap tables, valuation, and dilution. My name is Anoosheh. I'm a graduate of MIT Sloan Fellow MBA program, class of 21, and I'm the co-founder of Crimson Founders, where we are building a supportive network for MIT and Harvard affiliated founders and startups for now, and we are going to expand in future. I'm also one of the founders and organizers of the annual MIT Female Founders Pitch Competition, which I'm thrilled to announce that its 3rd edition will take place late in March 2025 at the Deutsche Bank Center in New York City. And that exciting news, applications are open now. And the link to the application, I am going to share it in the chat. You can also find the application form on our website, which is mitfemalefounders.com. I want to thank MIT Sloan Club of New York leadership for supporting MIT female founders for so long, and thank my teammates Peter Dolch and Karen Tilley for our incredible journey together and for their constant support. Quick note on logistics today. This session is being recorded and it will be shared on our website, MIT Female Founders website and YouTube channel and our social media platforms, including LinkedIn, WhatsApp, and Instagram. I'll share the links to all these platforms in the chat. And today, considering that we had over 500 people, about over 470 people registered for this session, we are using Slido for Q&A to prioritize the most uploaded questions. And since Slido has a cap of 100, please submit your questions early. And to avoid the repeats, check existing questions and upload the ones you'd like prioritize. I will share the Slido link in the chat as well, and Colette will also throughout the session in case somebody logs in later. If you have any questions, I always love to connect with founders, so please feel free to reach out. I'll share my contact details in the chat. Now, it's my honor and privilege to introduce Kristen Kraft. She's a powerhouse in the startup ecosystem and currently Vice President of Business Partnerships at Fidelity. Kristen leads Fidelity's startup engagement platform, supporting founders and investors with her deep expertise. From equity management tools to fundraising strategy and go-to-market best practices, Kristen is shaping how startups navigate their most critical financial milestones. Her journey includes being a founder herself and over a decade as a startup operator with deep expertise in strategic partnerships and digital marketing in the B2B SaaS space. Kristen has a bachelor's from Brown University, a master's in education from Harvard University, and an MBA from MIT Sloan. She is a passionate advocate for building community and supporting diverse founders, and we are so thankful to her for doing this workshop for our community. Without further ado, welcoming Kristen Kraft.
Thank you so much. And thank you for the kind words. I'm so delighted to be here. I will get into it and share my screen in just a moment. But what I love best, especially coming from a startup world myself and a founder journey myself, is helping founders succeed, helping startups grow and achieve the success that they want. And so often that hinges on a founder's ability to raise money. So that is what we will be focusing on today. That is a huge part of my work day to day, is helping founders raise. So excited to jump right in. I'm going to share my screen. We'll expand. I trust that everybody can see all right. Terrific.
Yes, yes,
All
perfect.
right. So we will be digging into preparing to raise and elements around valuation, dilution, cap table management, and general fundraising best practices. A little bit of context, as you learned, I am a former founder myself. I had not anticipated to go the entrepreneurship journey. I had planned on being a math teacher when I was in undergrad at Brown, and sort of by chance, a classmate and I decided to launch a company, and it was the most fun I ever had. There was a part of me that was sort of astounded that anyone could just start a company. It was just so much fun, such a learning experience, and I really just fell in love with the startup ecosystem and the sort of resources available, especially among some of these hubs like New York City, like Boston, like SF, and really I think everywhere is a startup hub now, just given what we've seen about founder trends. But it's a really exciting community to be a part of. So I'm thrilled to now be part of everyone here's community. And I would love to be a resource to you right now and then going forward. So I'll share my contact info at the end if I can be of help to anybody. But day to day, I spend most of my time mentoring, advising, sharing best practices with founders and investors, and cultivating relationships with the best startups, the best founders, the best investors in my role at Fidelity. Just by way of context, we tend to focus on a really important input on the fundraising process, which is the cap table and the data room. And that is sort of what we tend to do with Fidelity Private Shares. I'll share a little bit more about what that means, because I think there's some important nomenclature that we'll just get on the same page on. But as I mentioned, I spend a ton of time also on founder support. And so often, I mean, again, especially for first-time founders, you might not know what you don't know. It might not be clear what sort of fundraising strategy will make sense for your company, what you should have in your investor pitch deck. So I love doing that kind of work with founders. So our agenda for today, we will set the stage with a few key terms that are important to know. Then we will dig into valuation. We will dig into dilution. We'll talk about modeling out future raises, because that is, top of mind with so many folks, I find in my day-to-day. We'll talk about best practices for fundraising. And then, as I mentioned, I'll share my contact info, and I'd love to stay in touch with anybody, or please connect with me on LinkedIn and reach out anytime. So let's jump in to some of the key terms that are important to know around ownership, equity, which tie into valuation and dilution. So first of all, I think it's valuable just to set the stage with the kind of common understanding that fundraising is sales. You are selling your product or service. You are selling your vision for the impact that you want to have on the world. You are selling yourself as sort of the person to solve that challenge. And therefore, you need to know your buyer. Your buyer in this instance, generally speaking, is a VC firm or another type of investor. And they tend to care about all sorts of different things. Different VC firms, different investors care about different things. But in my experience, pretty much all of them care about understanding the foundations of the business from the financial foundations of the business. Who owns what stakes in this company? If they are to write a check to your company, what will they own? What are the potential risks and rewards of that ownership position? And so again, it comes back to knowing your buyer and to speaking in the language that they speak. So a few key terms I would love to go over just to help set the stage for this time that we have together. Your cap table or capitalization table is the single source of truth, if you will, for who owns what in the company. If you are a solopreneur who has not raised money, you might be the only person on your cap table initially. If you have a founding team, it might just be you and your co-founders. If you start to raise money from friends and family or angel investors, those individuals will join your cap table. If you do an institutional round with a VC firm or a corporate or strategic investor, those people will join your cap table. You might even end up deciding to extend some equity to strategic advisors, perhaps, or even, a professor who's an expert in the field that you want to, have skin in the game on the company that you are building. So your cap table, again, is the single source of truth for who owns what in the company. Your data room is sort of the other side of that same coin. Your data room is the location where you share all the important documents about the company. And specifically, it generally speaking must contain all the documentation about ownership. So, for example, if you do raise a round with a venture capital firm, that firm will expect to see ownership positions and documentation there in your data room. They will want to see any equity or options grants that you've made to advisors there in your data room. And the reason that this is so important is, perhaps someday, hopefully, you have an amazing liquidity event. You decide to IPO or you have an acquisition. It's critical at that moment to have clear perspective on who owns what to determine what sort of liquidity goes to whom. And so that data room and the accuracy of the data room and the cap table are paramount. And really, you want to make sure that you always have parallel information in your cap table in your data room. If, for example, you decide to grant equity to a strategic advisor, the letter and documentation of that should live in your data room. And then the line item expressing that ownership stake should live on your cap table. So again, there's sort of two sides of the same coin is how I tend to think about it. And then equity, I know I've used this term a lot already. But equity is ownership, is an ownership stake in the company. Sometimes people buy equity and by funding the company, a VC firm has an equity position because they write you a check. But other people might gain an equity position because they are, lending their time and their expertise in the example that I shared about a strategic advisor, for example. A few other key terms to know include term sheets and lead investors. So generally speaking, by the time a company is raising their Series A, they are going to be talking with institutional firms like VC firms, like corporate venture capital. And those types of entities will give you a term sheet which expresses and codifies the terms of the financial agreement they are entering into with you and with your company. Those term sheets can have a lot of different parameters. There's some incredible templates that you can dig into to understand like what are the elements that often show up in term sheets. But they will give you a term sheet that codifies the sort of stake that they have in the company and any kind of qualifying factors, like who gets liquidity first in the instance that there is an IPO or an acquisition that creates liquidity. Your lead investor is, generally speaking, the entity that writes the term sheet. And then you might have other investors who are typically called follow-on investors who join in on the round. This, I'd say, is especially important to know if you are thinking about raising your Series A, because you need to have, generally you need to have a lead investor and then other investors hop on. So oftentimes I talk with probably dozens of founders every single week, and it is not uncommon to have had, 50 conversations with investors, many of whom might say, hey, I'm interested, but I probably won't lead this fundraising round. Please come back to me if and when you have a lead investor. And so oftentimes it's a matter of having 50, 100 conversations with investors in order to get one yes from a lead investor. And then you can go back to all the other conversations you've had, say, hey, I have a lead investor. They've given me a tentative term sheet. Would you like to join this fundraising round as well? So important things to keep in mind as you are, calibrating on your own time and your to-do list for closing a fundraising round is getting to that lead investor, and getting a term sheet from your lead investor is usually sort of the first domino that you need to get to fall in order to get all the other dominoes to fall correctly. Pre-money valuation and post-money valuation. So valuation is, an indicator, a number about what your company is worth. And valuation can be determined by many different things. If you are, in a SaaS company or building a SaaS company, that is my background. Oftentimes, valuation is some multiplier, let's say for the sake of argument right now, 5 times what your annual recurring revenue is. And there are different ways that valuation can be determined based on the industry that you're in, based on your stage, based on your annual growth rate. The pre-money valuation expresses the value of your company before you complete a fundraising round, whereas the post-money valuation expresses the value of the company after that fundraising round is complete and that money goes into your company. And then last, I alluded to this earlier, but liquidation preferences. This is the order of operations, if you will, that determine who gets paid out what, when, and in what order, most importantly, if and when a liquidity event happens. And generally speaking, investors tend to want the most attractive terms. So they will oftentimes put liquidation preferences into term sheets. I do recommend very highly in this book, Venture Deals. It is, kind of the be all end all in many startup and venture circles around how startup fundraising works, how VC and CVC funding works. It goes into a ton of nuance. So if any of this that I've covered is newer to you, I would strongly encourage you to check out Venture Deals, because it really goes into incredible detail, and it's very, very readable, really well explained around what some of these terms look like. The other resource I should flag is Y Combinator, one of the most successful startup incubators in the country, has a wealth of resources, sort of example term sheets that you can look at. So that might be worth Googling as well. Why don't I pause there in case I know that was a lot. I just didn't want to kind of jump into any esoteric nomenclature without setting the stage in advance. But I would love to know if there are any questions that I should answer.
So we have a whole bunch of questions.
Mhm.
In particular on this slide, I really want you to go deeper on pre-money valuation versus post-money valuation. And investors usually prefer post-money valuation to lock in those percentages for themselves and feel safer, and how founders should prioritize among their investors. And one question that has also the highest votes is like, it's that, hold on, talking about, can you talk to founder investor fit? What are some of the pitfalls that first-time founders overlook when finding investors? And I'm thinking also negotiation, if you can also talk more about the pre-money valuation versus post-money valuation, negotiating that with investors also, that would be awesome.
Okay. Great questions. Um, and I think that they are somewhat related. So, investors, in general, want to have as much ownership and control of the company as possible. And they certainly don't want to undermine a founder's commitment, and equity in the company. But they do oftentimes want to have preference over other investors, whether, from that same round or in subsequent rounds. Um, It is generally more advantageous for VC firms to use a post-money valuation. It is generally more advantageous for founders to use a pre-money valuation. There's no one right way of doing it. During moments like 2021, when venture funding was flowing like gangbusters, when founders were really in the driver's seat, I saw a lot more term sheets that used pre-money valuation because founders were able to be picky and more demanding. During 2023, let's say, when it was, the sort of power dynamic had tipped more towards investors, all of a sudden I saw investors being a little bit more demanding of wanting post-money valuations within term sheets. So there's no one right answer. Things inevitably kind of ebb and flow depending on whether it's a buyer's market or a seller's market. I think that the sort of like nuances of how to have this conversation, and especially like getting into the math behind it, it gets a little bit tricky, but it's super helpful to see some examples. And I will say again, Venture Deals has some really cool examples where you can see the way that or the differences that will impact you and your team, whether you use pre-money valuation versus post-money valuation in your term sheet. So I'd encourage you to kind of like dig into, if there's anybody else who loves math as much as I do, you will love seeing the examples that exist there, because I think it really helps to illustrate how some of these decisions will impact you down the line. And then I want to bring this back to the other question about how to gauge if an investor is the right fit, because I do think it's related here. A good investor is somebody who wants to be a long-term partner to you. They want to be in your corner. They want to lend advice. They want to lend a hand. They really want to be there in the trenches with you during good moments and bad. A good investor relationship will not feel predatory. It will not feel adversarial. Sure, there might be moments where there are differences of opinion, but it should feel like they're always in your corner. And the reason I say this, and I can touch on a few of the other factors that make for a good investor relationship, but the reason I bring this up vis-a-vis, term sheet negotiation, is, if you are negotiating the terms of the term sheet with a potential lead investor and things feel like adversarial, that's a really important indicator. I mean, sort of pay attention to your instincts there, because oftentimes the investor relationship that you're entering into, like that relationship is going to stay with you sometimes for 10, 20 years, depending on the trajectory of that company. And you don't want to have somebody, who's going to be making your life challenging day to day, who's going to be causing distractions that impede your ability to grow your company in the best possible way. So I'd say, in terms of gauging whether there's a good fit with investors, I mean, there are some table stakes elements. Is the investor really focused on the industry and the sub industry that you are in? I am, going to a climate tech event later today here in Boston. So I'll use climate tech as an example. If you are in the climate tech space and you are laser focused on energy storage and batteries, and specifically you are trying to sell these batteries into the automotive industry, a great investor ideally is somebody who's really passionate about climate tech, specifically about energy storage, and maybe he or she has even worked in the automotive industry. Because I think that it's worth saying that a great investor relationship represents so much more than the check that they write. I mean, yes, that check is really impactful in terms of your ability to grow the company, but hopefully the investor brings a ton more to the table as well. They are sharing advice, they are making introductions on your behalf. Perhaps they are helping you navigate larger enterprises for business development and sales opportunities. So you really want to have very tight alignment between the space that you are in and the investor that you go with. I'd
Perfect.
say, there's the element of trust as well. That one's a little bit harder to kind of gauge on paper. But I think that's the kind of thing that you get a feel for over the course of, meetings and over the course of negotiating a term sheet.
Great. Great point. Kristen, can I send also one more question because questions are coming in, or do you want
Sure.
to on with the rest of the deck and
If
be
you want to pose one more question, I'll try to be, succinct in my reply, and then we'll turn back to it. But yeah, go right ahead.
just what metrics do SaaS companies with implementation, non-recurring service revenue, but with implementation components in addition to ARR, like SAP, Salesforce, Alteryx, need for Series A?
Okay, great question. And I mean, in SaaS, so and non-recurring revenue was part of that question, Anoosheh, is that right?
Non-recurring service revenue. Yeah. What metrics do
Okay.
SaaS? Yeah.
Okay. I would say in general, VC firms especially strongly prefer recurring revenue metrics. And then everything that is tangential but related to recurring revenue. So, MRR, ARR, those are, monthly recurring revenue, annual recurring revenue are really important metrics to have. And then the sort of related metrics around churn, customer lifetime of value, expansion revenue. If you have some percentage of folks who predictably move into a higher paid plan. Non-recurring revenue, such as implementation fees, are of course important revenue sources as well, but it's really hard for VC firms to kind of like wrap their heads around those pieces just because they're not, they introduce risk. If it is not recurring, there is a risk that it could disappear tomorrow. Whereas it's challenging for some of that recurring revenue to disappear, and to catch you off guard. So to the degree that it's possible to kind of like bake that non-recurring model into your, or non-recurring revenue rather, into your model, that will help allay some concerns that they shouldn't even kind of count that non-recurring revenue. And then there's one other the other thing I was just going to touch on is, right now, every investor that I talk to is looking for vanilla. Like people want things that are right down the fairway. Anything that's sort of more unusual or requires explanation, investors are kind of shying away from because they want to reduce their risk. It's a moment in time where, SaaS businesses are, doing a lot better than they did 2 years ago, but some folks are still on shaky footing. So I'd say that to the degree possible, to kind of make sure that your metrics and your pitch and your business model are as vanilla as possible, that will help, one, you increase your chances of getting investors and lead investors specifically, and two, avoiding questions that cause, the whole fundraising process to slow down.
Great, great. Thank you so much, Kristen. Great. And I actually want to also bring up some trends of fundraising I see here in the Middle East. And actually, we this week as Abu Dhabi Finance Week, and we have a lot of people from MIT here who are meeting with investors. And I want to get your opinion on those industries as well. But let's move on right now. And we have more questions coming on, and then I'll send it about founder split, which we have to cover. But let's move on for now, and then we'll take it later.
That sounds good. So a few valuation benchmarks. It used to be the case that annual recurring revenue of 1 million was sort of the goal for Series A. Now increasingly investors are looking for ARR numbers that are about 4 or 5x that. Admittedly, the size of a typical Series A has gone up dramatically as well. So this is sort of changing the goalposts or moving the goalposts is not necessarily inherently a bad thing. I think it means that just folks are their expectations are a little bit different than they were even like 5 or 6 years ago, quite honestly. Just in case this is helpful to know if there are folks who are a little bit earlier stage who've joined us today. I will say that, a lot of folks like to joke that, a seed round is what a Series A used to be. And a pre-seed round is what a seed round used to be. A ton of people are now doing a seed plus round if they're maybe not quite at this Series A ARR level within SaaS. So I think it's just good to know that, the expectations have shifted a little bit, but because there has been so much activity even earlier around pre-seed, seed plus, there is still plenty of room to think about your valuation if you are not quite at this juncture with a Series A. Valuation tends to, generally speaking, be 2 to 3x your previous post-money valuation. So if you did a seed round 2 years ago, you'd want to look at those metrics, again, post-money, to determine like what your valuation might be for your Series A. And post-money valuation tends to generally be your annual recurring revenue times an industry multiplier. There are some terrific data sources online on this. As I was looking for some data points, like quite honestly, there are so many different opinions. I didn't really want to choose like one to say that this is sort of the be all end all. I would encourage you to Google this. You will not be disappointed in the volume of opinions that you will find. And you can get really, really granular into like, I'm in this industry, this sub-industry, here's my specialization, to find what sort of industry multiplier you might want to be looking at for your business. I'd say some other important inputs on valuation can come from other companies. So I'd strongly encourage folks to do as much research as they can into comparable companies. Oftentimes, fundraising rounds, valuation from competitors or others who are in your space, those can be really important bellwethers of the valuation that you might expect to see for your company. Do keep in mind that timing matters. So the sorts of valuations, again, that were happening in like 2021 are very inflated. I wouldn't necessarily suggest looking at a fundraising round that happened with a competitor in 2021 and assuming that you will see the same thing. It's just sort of a different market right now. So ideally, when you're looking for comparable companies, you want to be looking for ones who've fundraised recently. Again, great data out there on industry and sub-industry averages. And then last, intellectual property does tend to impact valuation when it comes to fundraising, when it comes to M&A, when it comes to IPO. I saw a statistic recently that IPOs where the company has some IP in play tend to see 30% higher valuations. So, again, it differs so much from industry to industry, from company to company. So do your research if you can. PitchBook tends to be a great source of data on fundraising from other companies, from VC firms. So that can be a good place to start. I think it's also worth knowing that you want to focus on a valuation that you can grow into. To a certain degree, so I'm just double checking this is not on my slide. So it's to a certain degree, when you have the valuation for a round, like that is kind of the value the company is expected to achieve before the next fundraising round. So while many founders consider it an amazing thing to have a really high valuation, like it's a feel-good metric, admittedly, it can also be a risk. So to my point there, a high valuation can be as challenging as a low one, because it's really setting a very high bar for what you need to achieve in terms of the growth rate and traction and success metrics before you were able to go back to the market to raise a subsequent round. So, if you are in the fortunate position of having competing investors, writing competing term sheets, you don't necessarily want to go with the one that's giving you a sky high valuation. Unless you are very confident that you can grow into that valuation before you run out of cash runway and have to go back to raise a subsequent fundraising round. When it comes to valuation, generally speaking, you want to try to avoid being the first person to throw out a valuation number. It is very appropriate to ask an investor, especially as they start to indicate that they want to come on board. It is totally appropriate to say, hey, I know you see a ton of deal flow, like what valuation feels appropriate to you? They might try to kind of play the game and try to get you to say the number. It's a feel thing. There's no one right answer. Of course, you always want to be polite, but it is fair to try to lean on them to say the first number. And then last, one of the valuation inputs that's super important during the Series A is product market fit. I.e., have you demonstrated that the market has a willingness to pay for the product that you or service that you are offering? Is their willingness to pay aligned with the pricing that you have set for your product or service? And during the Series A, oftentimes investors also like to see that you have a repeatable sales process, i.e., if they put $10 million into your business, can you put that $10 million to good use and then scale your go-to-market and scale your revenue? So really like that's what they want to see. So demonstrating you have that repeatable sales process in place helps to instill confidence and helps to de-risk the investment for a VC firm or another type of investor.
Listen, before we go to
Of
dilution,
course.
I want this is a very, very good question. And it's one that keeps coming. It's also like this person has asked for biotech, but I like if we can talk about also how co-founders should divide equity. The person who has asked, and MIT has a lot of biotech startups, it's that how to divide equity between co-founders of biotech. For example, a professor functions as an interim CSO at 20% time. The CEO is an experienced executive. So this is more like targeted, but like also more and more I see also questions like, for example, somebody starts a company and they want to bring a co-founder and they don't know like how much equity to give away or what issues they should, but maybe it doesn't work out after 1 year. So what terms they can include to say goodbye amicably, or would they need to give up shares from the beginning? How would that work? But let's first if you can answer the first question, how to divide equity between co-founders of a biotech company.
Yes, great question. I think the biotech angle is particularly interesting because oftentimes it's an industry where there is IP. Oftentimes there are really important relationships that maybe one party brings to the table, in terms of some of those strategic partnerships that a biotech company needs to have in place. So it's complex, admittedly. One overarching piece that two overarching pieces that I will cite when it comes to dividing up equity. And by the way, like these are both things that VC firms really prefer to see. One is you should not be dividing equity up equally among your co-founders. If there are two of you, you should not have the same equity position. Ditto if there are more than two of you. At the end of the day, you want one person to have a more sizable position. Honestly, to sort of like break a tie, if you will, metaphorically speaking, if there are any decisions that come up where you need to have one person who makes the final call. Again, like VC firms prefer this. You know, if you think about it, it's really, again, all about de-risking for them. They want to know that if they put money into a company, they're not going to end up seeing that company get into a holding pattern for 6 months where you have two founders with equal stakes in the company duking it out and going to court and burning all their money on legal fees. So I say that's element number one. The second element that is really important to think about, and then I will get back to the very specific question around biotech companies. But the second element that VC firms really like to see is some documentation and agreement about what will happen if co-founder conflict does arise. So, you know, this is somewhat anecdotal, although I have seen some data on this also. You know, co-founder conflict is one of the biggest causes, like why companies end up failing. And that kind of co-founder conflict can really exacerbate other adjacent issues like running out of cash runway. You know, and it's okay. Like sometimes it's nothing there's no ill intent. It's just that one person maybe realizes like, hey, I am starting a family and I really need a regular paycheck and healthcare and like I need to go my own direction. That's okay. Like that happens. And the goal in situations like that is to be able to divvy things up, wrap things up amicably. So perhaps there is documentation about what you will do in a situation like that. Perhaps you have documentation about how one founder might be able to buy out the other founder's shares and percentage ownership in that company. Perhaps it's some other agreement entirely. Maybe it's some agreement for future liquidity. So, you know, I'd say there, again, there's no one right answer, but knowing that, you know, for an investor, knowing that that kind of documentation agreement exists can really help to assuage fears and de-risk the investment on behalf of the investor. And then coming back for a quick second, if I may, on the biotech example, I think what's interesting about this question is it acknowledges the fact that like different folks bring different elements to the table. You know, there's this 20%, you know, professor who is adding expertise, who's probably adding really important connections to the company. That is hard to quantify, admittedly. And oftentimes the way that you get to the answer about what sort of ownership percentage is expected here is everybody sitting down together and really like getting to brass tacks about what each person can contribute to the company. So, you know, I think it's reasonable, even when you are bringing on an advisor, even if they are fractional, to document on paper of like, here's what we are expecting based on what you have indicated as value that you can bring to the table. If this changes, you know, if you decide that you want to move higher or lower than 20% time, here's how your ownership position might change. So, you know, I'd say, unfortunately, there's no one right answer. But I do think that the end goal is to have things be very clear, very well documented, and to be able to articulate and demonstrate that clarity and documentation to a prospective investor.
Sure. Thank you very much. So let's go to the dilution. The next question with the highest votes is actually about the dilution and future employee stock options. And I know that every round that you bring on new investors, they want that you have issued your stock options that you want to give to your employees. You have put it aside for the new round because they don't want to get further diluted. So after your dilution this slides, I'm gonna share the question, or maybe you can answer during, is that how do you account for the dilution of future employee stock options and CEO/board stock options? Will the VC investor be equally diluted as the founder?
Okay. Great question. We will actually be touching on much of that. So this is great timing. So forgive me if folks know this, but dilution sort of indicates like how does your ownership position change, i.e. Diminish over time given subsequent terms. So, you know, as people are putting money into your business, they start owning some of the company and you own less of the company. for what it's worth, and I guess this was sort of a subtext of that question, but for what it's worth, generally speaking, most founders allocate about 10% of the company for the employee pool. And that is you can refresh that in the future if it feels right and if the math works out right. But that is sort of the employee pool that you use to give, options grants, equity grants to key hires that you make in the company. Dilution is important to know, not only because it impacts you and your finances, but it also impacts the attractiveness of the investment for an investor. So it can be tempting to raise more money, given uncertainty around future raises. But keep in mind, if you do that, you are diluting yourself by doing that. You are potentially diluting earlier investors by doing that. And, this is probably where I direct folks back to venture deals, because I think this is one of those examples where it really, really helps to see like the math equations directly. But depending on the terms that you have in your term sheet, an earlier investor might be diluted differently than a later investor. Or if you have terms in your term sheet that allow investors to come in at the terms of an earlier raise, they can minimize their own dilution. So again, I'd say dig into venture deals. It's kind of it's much easier to see than to explain verbally. The one thing I want to show a visual that I love, because I think it just really helps to indicate risky territory, is around a broken cap table. So I've heard this term broken cap table thrown around a lot. I generally hear it used in two regards. One is the cap table is just messy, inaccurate. You never want to go there. You always want your cap table to be well organized. It's a really important input for VCs. The lawyers will look at it during due diligence before you are able to close on a fundraising round. You never want that kind of situation. The other way that I tend to hear broken cap table used is a cap table where the founders, generally speaking, but it really could be sort of any really important team members, have too little skin in the game. You don't want to get to a situation where you've sold so much of your company to VC firms, let's say, that you own a tiny, tiny percentage. Because again, it comes back to de-risking for VC firms. VCs don't want for you to have a really bad day, week, month, year, and decide to leave the company. If you are a critical element necessary for that company's success, they don't want you to have so little skin in the game that you decide to jump ship and go on to take some, cushy job at wherever with good healthcare and benefits and yada yada. I'm going to show you this broken cap table example in just 1 second, but last piece worth knowing. Many investors like to see about 24 months of cash runway at a minimum. This is not a hard and fast rule, but it is important to keep in mind as you are thinking about the amount you are raising and when, as well as the dilution. So dilution also has an impact on a team. Raising more money and raising at a higher valuation, as we touched on, puts a greater burden on the company to hit benchmarks before you can go back out and raise a subsequent round. It can also introduce the risk of team dissatisfaction. If you are overly diluting your team members and key executives, that can be risky. And therefore, you want to make sure that when you are spending money, you are doing so on strategies and tactics that build intrinsic value in the company in order to avoid unnecessary dilution. So, intrinsic value might be campaigns that you run to build up your sort of top of funnel and your pipeline. It might be, registering new IP, sort of things that will hold on to ads. During the heyday of 2021, we saw a lot of companies that were doing things that did not build intrinsic value. They were just, a lot of companies were kind of willy-nilly running a ton of Google ads, let's say, and seeing no ROI. And once that money is spent, it's gone. Instead, the kind of intrinsic value build, even, building new products and feature sets that can drive future success, that is intrinsic value. So this is the table that I really find very helpful to think about. as you can see here, along the top row, this is the sort of different stages. And because we're talking a lot about Series A today, let's look at that Series A column sort of in the middle there. Best case cap table, you want to see the founder or co-founding team owning about 50% of the company in total. I mean, again, if you have co-founders, it should add up to this. With your investors, as well as 10%-ish going to the employee pool. Investors will get nervous at a Series A if you own 10%, 20%. 30% is like, okay, like it's not ideal. But 50% is something to strive for. And as you can see, the founder or co-founding team's percentage and holding will change over time, will diminish over time with every subsequent round of fundraising. This is very normal. And it makes sense. We're just sort of thinking about the fact that every time you raise money, you are selling some of your company to those investors. But in general, you want to make sure that you're always hanging on to an appropriate based on your stage amount of the company, so that an investor won't worry that you are going to jump ship if and when times get tough. And as you can see there at the bottom, this does tend to be a little bit less of an issue with other types of investors aside from traditional VC firms. So corporate venture capital is known for being a little bit more patient. Family offices, private equity, venture studios are a little bit less picky about this. But in general, like, you want to strive for that kind of best case cap table row. And maybe if it's okay, I will move a little bit fast through the next 2 slides, just so we can cover everything. Does that sound okay, Anoosheh?
Yes, sounds good, Kristen.
Awesome. So, we've talked a lot about, future raises, dilution. It can be really, really helpful to be able to see this and play around with this. For what it's worth, we have a free tool for folks who've raised under $1 million, where you can input all sorts of different parameters that you might see on a term sheet, and then see how ownership positions will change given terms of subsequent raises. So you want to make sure that you are planning for the best case scenario and really thinking about like how equity positions might change given subsequent rounds, given a potential IPO someday. You also want to be making sure that you're managing equity and documents correctly from day one. It is never going to be easier to make sure you have a clean cap table and a clean data room than it is today. So if that cap table or data room needs some cleaning up, spend some time on it. Will save you a lot of headache down the line. And then a few best practices on raising your next round. So again, fundraising is a sales process, and like any sales process, you have a funnel. So you really want to make sure that you're building your funnel thoughtfully and nurturing that funnel. So most founders and investors I work with tend to cite about 50 to 100 conversations that a founder will need to have to get to, one lead investor. So, as you're thinking about the amount of effort and work that it will take to raise your round, you really kind of want to anchor yourself to that idea that, you need to be having 50 to 100 conversations. Ideally, I love to see founders who have these really nicely organized in a spreadsheet as you are doing research into different VC firms or different angel investors or what have you. Add every single one to your spreadsheet. Include details about, industry focus, any past investments they've made in adjacent companies or even competing companies. If you identify investors who are a great fit for your company, but not at this stage, add them to a tab for your Series B round. This kind of database, if you will serve you very, very well in the future. Investors are notorious for wanting to meet and chat with founders when those founders are not raising money. They really like to see how somebody behaves, how somebody communicates, how they stay in touch over time. When they say they're going to do something, do they end up following through and doing those things? So a lot of investors like to get to know you, minimum 6 months, but ideally like 1.5 years in advance of a raise, so they can get a feel for who you are and how you operate. You want to nurture those relationships over time. One thing that, in my opinion, the smartest founders do is share a monthly or a quarterly newsletter. This can be very straightforward. Again, like I probably talk with hundreds, if not thousands of founders every single year. And I would estimate that only about 10% of founders do this. Whereas like 100% of investors like to see this. So if you really want to stand out from the crowd, I would strongly encourage you to think about teeing up kind of a regular communication that you share with folks. I would bet good money on the fact that like the vast majority of investors you reach out to, if you say, hey, I want to share a quarterly update on how my business is going, would you be interested in receiving this? The vast majority of them will say yes. And it's just a good way, again, of demonstrating how you communicate. How thoughtful are you? When you say you're going to do something, do you do it? And keep in mind that as you are getting to know investors, honesty is always important. If you have questions, ask them honestly and directly. So, for example, it is perfectly appropriate to ask questions around a company's investment thesis. I mean, do your homework in advance and read up on that information online, because generally speaking, most VC firms will share that very publicly. But also okay to ask what percentage of the company they want to own, to ask about how involved they want to be post raise. You know, one of our attendees today asked that great question about like, how do you gauge investor founder fit? I mean, some of that comes down to like, what are you looking for? Do you want an investor who's going to be checking in with you every month to say, hey, how are things going? Like, can I lend a hand on it anywhere? Or conversely, maybe you're like, I don't want that. Like I've built 20 companies before. Like I actually prefer an investor who's not going to be like, who's only going to be there, like even when I reach out to them. So it's a little bit about like what level of involvement is right for you. And that's an appropriate question to ask an investor of how they like to be involved in case there is misalignment there. And then use your founder network, you know, your Sloan network to do your own due diligence on investors. If you are using a resource like PitchBook or any other source to identify investors that are in your space and have invested in companies that are adjacent to you, for example, see if you can get to know some of the founders from those other portfolio companies to ask what their experience has been like with that investor. Does that experience align with the type of experience that you want to have with your investors?
That's a great point to do the reversal. Like ask the other startups like what was their experience with that investor. I love that, Kristen. So Kristen, we have a lot of questions. So let me first ask. So hold on, I'm trying to prioritize these. These are all great questions. So let's go for the first one, which is what is the difference between safe notes versus convertible notes, and when is that preferred over equity? Not sure what they mean, but when is that preferred over equity? But difference between safe notes and convertible notes.
Yes. So in case folks are less familiar with this, a safe note is something, it's a relatively new term and new entity, but it stands for, it's an acronym standing for Simple Agreement for Future Equity. And the reason that a lot of folks prefer a safe note is because it allows you to sidestep the need to place a valuation on the company. So for example, like Y Combinator, I think Y Combinator is the entity that invented safe notes. You know, for really early companies, like companies going through Y Combinator, it's a little bit, you know, absurd to try to value a company that might be pre-revenue, that might even be pre-product. I mean, how are you meant to value a company that has so few data points that indicate what that company is worth? And so a safe note allows you to sidestep that valuation. And instead is sort of guaranteeing future equity based on whatever that valuation happens to be in the future. So that safe note will convert in the future once a valuation is conducted. And then the other question was around convertible notes versus safe notes.
Yeah, adding here, I think the convertible notes, they have an interest. They've worked like a debt.
Yes, there's
So
a debt element on convertible notes.
there's the interest rate and there's the maturity date, and there's an interest rate on it, whereas safe, it's there you don't have that. But there are other complications. There are other negative points with safe. Y Combinator has a bunch of great videos, and I'm going to make sure to send a whole bunch of resources to everyone who signed up. We are going to get the email list from the club, and we are going to share some great resources on that as well later. Kristen, do you want to add anything on the convertible notes and safe?
I would say that, like, in my experience, you know, safes tend to be most common for like a pre-seed round, a seed round. You almost never hear about convertible notes with those, like, pre-seed, seed, even C plus companies. And then conversely, safes almost never come up with like Series A, Series B, Series C companies. So there's also, to some of the points that you touched on around like debt and timing, elements that are, a bit more like esoteric, and less, not advantageous, like less tolerable, quite honestly, to really early stage founders. Whereas those convertible notes tend to be much more common, when there's more complexity to the business.
Sure. And also convertible, so safe, the next round, the next price round, you should know that it converts to equity. So even if like you don't want to issue shares to anyone yet, like in your next round, safes are like they convert to equity, and you need to determine like how much shares each of them is going to get. But convertible notes, you can put a amount like when you are raising like $5 million, then that's when it's going to turn into shares, I think. Anyways, now going to the next question. So we did this. What are seed or Series A investors looking for in a consumer startup company? Do they focus on more on traction? If yes, is it a retention, growth, or total daily active users?
Great question. So in consumer, consumer can be notoriously a little bit like harder to value, because revenue can be less predictable. And so, one of the metrics that I see a lot of consumer investors looking for is like an indication of likely future purchasing. I mean, I think it's one of the reasons why you've seen a decent number of consumer companies moving towards a subscription model, for their consumer product. In the absence of that, I think there are other angles that you can pursue that kind of like lend themselves to similar predictability. So if, for example, you can get contracts in place with, Whole Foods, Walmart, CVS, like that really can help to assuage fears around riskiness for a consumer investor. If you have letters of intent with distributors, that can be a really important input. I'd say that at the Series A, having revenue predictability for a consumer company is very, very important. At the seed round, there tends to be a little bit more flexibility. And then I guess one other piece that I'd say is, especially for seed companies, oftentimes having other leading indicators, like maybe you have a wait list, maybe you have a really avid Instagram following, or can you tap into prospective buyers easily? Like have you built the foundations that will let you tap into future money, even if you don't have like a recurring revenue model? So I'd say those are some of the things to make sure you're highlighting in your investor deck if you have those metrics. And if you haven't started doing those things, if you don't have, whatever, an Instagram account, a Facebook group, whatever, wherever it is that your buyers tend to congregate, it's worth thinking about doing, because those leading indicators, again, can just help to instill confidence and de-risk the investment for your investors. And I think this question also touched on like other metrics. In the consumer space, revenue expansion is also a really attractive potential upside. So, if you have, let's just say, 3 products currently, but you are planning to launch 7 additional products next year because your existing customers have indicated that they want to buy that in addition to the product they've already purchased for you, that's huge. Like you really want to indicate that revenue expansion opportunity, because again, it just helps to de-risk the investment on the part of the of the VC firm.
Great. Kristen, do you have time more, like 5 more minutes to stay with us
Sure.
to So, this one is interesting. It's about married couples, married co-founders. So, how do VCs view married co-founders and how can they address concerns? Does it help if only one partner has ownership equity? What do you think?
It's funny. I had a lunch with a few VC friends just recently where this very question came up. There are many differences of opinion here. If I had to put a number on it, I would say somewhere around like 75% of VC firms don't like to invest in companies run by married couples. And again, it's all about the risk. If something happens with the marriage, what does that then mean for the company? And like this is no, I mean, there are so many amazing marriages that like really go the length and are and exist for many decades. But I mean, looking at the data in the United States, 50% of marriages end, I think, if I recall. And so, I think most investors, if you told most investors like, hey, that in this situation, like, there's a 50% chance of co-founder conflict, like, do you still want to invest? That's a scary prospect. So, just full disclosure, I don't want to be the bearer of bad news, but like, I'd say more than half of VC firms prefer not to invest in companies that are run by a married couple. Um, this is a perfectly appropriate, I would say one, it is very important to address this like in a very upfront way. One of the one of the investors at this conversation the other week was saying that they almost invested in a couple where they had two different last names, and it became clear through the conversation that they were married. And had sort of been like trying to hide that. And the investor was like, in this case, we actually might have kind of broken our own rule and made that investment. But the fact that they were trying to pull one over on us just like felt so lousy. And we didn't want to invest in a company where like we were not all going to be open and honest with one another. So I'd say like, do make sure you are very upfront with it. I think there are also a tremendous number of upsides to running a company with your spouse. I mean, like probably there's like no one else that you're going to be caring about and like rooting for and supporting as your spouse. And so, finding an investor who sees those upsides is important. And I do think that from the equity question is a good one. I do think that that's probably a question to pose to an investor. How can I help this to feel less risky to you? I think there are certain, again, like there's certain documentation, there are certain agreements that you can put in place, i.e., if conflict arises, we are going to handle an XYZ way, such that it doesn't completely tank the company. Some of that documentation and that conversation can help to assuage investor fears. So I would pose the question to your investors or prospective investors about how they like to see that handled. I suspect that the percentage ownership, might help, but I think there are so many other factors that might come into play, where they want to make sure first and foremost that nothing will tank the company, that you're not going to get embroiled in any sort of litigation that will burn through your cash runway.
Sure. Thank you, Kristen. Now the next one, is it okay if we go two more?
Sure.
Okay, so if you're raising via convertible note or safe, do you still need a lead investor?
Generally speaking, yes. I'd say, sorry, I should say it depends. If you are raising a pre-seed, you're going with high net worth individuals, or even like a friends and family. Like I've seen people do safes on a friend and family round, not necessarily. If you are raising an A using a safe, then yes.
Okay, next one. What are your thoughts on talking to VCs while not fundraising? Inbound emails to just form a connection from a variety of VC quality. Um, Very, very important. I want to add, like, for example, like the MIT alumni who are here to meet with investors in the Middle East. They are just here to build those relationships for like future. When they want to actually raise the fund, I think this is very, very important, in my opinion, to build those relationships. But Christian, what are your thoughts?
I completely agree. I think it's so important to build those relationships. And honestly, you will probably have an easier time building those relationships when you are not looking for a check. I think to a certain degree, and this is natural, this is human nature. But I think all of us, like when we know somebody wants something from us, our defenses tend to go up a little bit. Just around uncertainty if we're going to be able to provide what they want. Whereas when you meet somebody and you don't want anything from them, like I think that all of us feel a little bit more comfortable being open. So I'd say that to a certain degree, it's easier to build those relationships when you are not fundraising. And again, investors like to have a long-term view into who you are, what your values are, how you like to run your business, how you communicate. And so, anything that you can do to show those attributes over time will just increase your chances of building a great relationship and also, potentially seeking investment in the future.
Great, great. Oh, Kristen, I just forgot to mention, can you stop sharing your background so we can have you on the screen, on the main screen?
Of course.
All
Yes, I should have done that.
right. Um, okay, last one. How to estimate a valuation of a biotech company with no short-term sales? What do you think?
Great question. And I think like, I'm sorry that my answer, this is like still lawyer. I'm not a lawyer, but this is such a lawyer answer. Like it depends. But truly it does depend. I know that I don't need to tell you, the person who asked this question, but there are so many phases within a biotech company, whether, you are running trials, what sort of like FDA approvals you might need to have, and you do have. And your valuation will be dependent on all of these inputs. I'd say that, a few elements, however, that do remain consistent, are one, is there IP involved? Again, the commonly cited stat is that companies with IP tend to see valuations that are about 30% higher than those that do not have IP. And then, the sort of makeup and composition of the founding team. If you are a serial entrepreneur with a past successful exit, for better or worse, like that probably means that you will have a higher valuation. So, I'd say, anything that you can do to highlight the sort of expertise, of your team, of your advisors, and then anything that you can do to lock down IP and make sure that you are just airtight there will only help. But I'd say it's so nuanced, especially in biotech, based on what space you are in and sort of like what phase you are at with clinical trials and other approvals that you need to seek. That I would hate to give you bad advice by stating something that's not like applicable to your specific situation.
Great. Kristen, I actually have to ask you this last question because it's we didn't um we didn't talk about it, and I wish we did a little bit more. Is that have a lot of this person said have a lot of Carta experience. Please summarize Fidelity's founder slash startup platform and services and how you position it vis-a-vis Carta. How is it different? And I would
Yes.
because I think majority of people in our founding community, they use Carta, and it would be great to learn more about what Fidelity offers.
Yeah, thank you so much. That's a great question. Fidelity Private Shares is similar to Carta and then does a whole lot more. So, we have, cap table management functionality and then data room functionality. One thing that I love that's a little bit different about Fidelity Private Shares is these two things are intrinsically linked. So if you update something in your data room, it will also update in your cap table, which is huge in terms of reducing liability and reducing errors in your cap table. We also have more sophisticated modeling tools so that you can assess and determine what your future equity holdings will look like given the terms of a future raise. 409A valuations, we really work only with the best of the best. Forgive me if you know this, but it is legally required for companies to conduct a 409A valuation once a year if they are granting equity. to establish the fair market value of that equity that's being granted. We work only with human experts. That is not the case elsewhere, unfortunately. And then last, I'd say, the sort of like white glove support, advice, best practices sharing that we do, really like fits our business model because we're in it for lifelong relationships with the best companies. But that is not really the experience that most founders tend to get elsewhere. Oh, and I guess like we're like half the price also because we don't really care about the ARR as much as the lifelong relationship.
Amazing. So I am going to check this with the club chair, Peter Dolch, who I am super grateful. He's the one who made this our event today happen and possible. But I am going to share with our community more about Carta. So everyone, I'm going to send a follow-up email. I'm going to share a bunch of also videos that I found helpful to educate myself. And also I'm going to share more about Kristen. I will share her contact information, which was shared on the slide, and also more about Carta. And I'm going to ask Peter Dolch if it's okay, if we can share
Fidelity
like,
private shares.
yes, yes, yes. I'm sorry, Fidelity.
No worries, no worries.
Sure. Fidelity private shares, what they offer, how is it different, and if there were any promotional offerings that we can share with our community, I will definitely share it in the email as well, but I have to check with the club's
Of
policy and regulations. Um,
course.
and the recording of this session will be shared. It will be shared through MIT Female Founders YouTube channel. It will be posted on MIT Female Founders website. And I will make sure to share it on the WhatsApp and LinkedIn page and the Instagram page of MIT Female Founders. I will also share it in all the WhatsApp channels that I am on with MIT community. I shared my contact details. So if there was any questions, please feel free to reach out. Both Kristen and I will love to connect with founders. And Kristen, I think she goes on numerous panels in Boston. And I remember, Kristen, you also organize a breakfast for founders in Boston. Do you still do that?
I do. I probably, as I mentioned, like there is nothing that I love better than helping founders raise money. So I love getting founders and investors into the same room together. And I tend to do things, about like once a week or so, in and around Boston, as well as New York and San Francisco. I have colleagues there and I travel myself as well. Yeah, Boston is home for me. So I tend to do a preponderance of events and gatherings here.
Are in the center of innovation in this universe. Where else is better? Boston is the best. Anyways, so everybody reach out to Kristen and contact her, share your founder journey, and go to one of her breakfasts in Boston for founders and investors. Kristen, thank you so much. We have many more questions. What I'm going to try to do is that I'm going to go through and maybe answer all of these questions with Kristen and send it in the follow-up email. I'm going to see if that's possible. Kristen, thank you so much again. I want to thank Colette as well. She and Jacqueline, who's the marketing chair of the MIT Sloan Club of New York, they did help us a lot to promote this event and help with all the logistics here. Anyways, Kristen, thank
Thank
you
you.
so much.
Such a pleasure. I really appreciate you having me.
Absolutely. And for we will have more of these workshops. And audience, thank you so much for joining us today.
Thank you. Wonderful to have you join us.
All right.